Well, hi there, everybody. This is Morris from San Jose Options, and today we're going to be talking about how to make the trend your friend. And we'll be looking at some of the traditional option strategies and how they face difficult times when the market does trend for a number of months. And we'll look at some of those typical adjustment strategies and make sure that you're aware of the risk that you're taking on when you're working with some of these traditional strategies that people consider to be neutral. In a trending market, many income traders using traditional strategies like credit spreads and condors tend to face difficult times. The condor trader will end up each month past the short strike and be forced to take huge losses, or they'll break even if they're good at adjusting. Credit spread traders may attempt to roll out farther in time and farther out of the money, only to find the same thing happen the next month. This adjustment process can quickly take you out of the game forever. There are other trades, however, that shine while traditional strategies fade away behind the scenes, the broken wing butterfly. So we'll get into that in a second. But first, let's look at the credit spread and the condor style during a trending market. So here we have a picture, a risk profile of a credit spread. This one here is constructed using close to a 10 delta. On the call side, we're looking at the Russell 2000. And this would be a pretty traditional standard type of bear call spread. And the goal here would be to collect this premium right here while risking all of this amount. So you can see you're risking, in this case, over the $9,000 and possibly going to make about $500-600. So I have those numbers are off the screen right now, so you can't see them. You can see them over here. So you're looking at your maximum. These represent the break even. So if you stay below anywhere this direction below, then you'll keep your credit. But if you end up on this side of your break even right here, then you can actually lose all of this amount, which is way down here, which is over $9,000. Okay, so this is what people consider to be a high probability trade, and usually these could be 80%, 85% probability. However, when you're trading these in a trending market, you'll notice this is only a 5%. In our software, this red line's 5%. And then you have 10% way over here. And once this market really starts to trend, 5% is nothing. We move sometimes 10% in a month as we're trending, so you're looking at ending up over here. For example, let's bring in the price chart. Okay, so now we're actually looking at just the last month. So notice from here you're around the 960 level on June 25th, and now up here, July 26th, we're at almost 1050. So you have just about 100-point move. So you can see right here we have about a 10% move just in the last 30 days. You have another tremendous move from this point to this point. Here you have a bit of a sideways market, but you can see how often when this market is really trending, you can see. Okay, so here you have, just look at, these are all like 5 to 10% moves over and over and over again for the last 7 to 8 months. So when we're looking at the risk profile, you're going to see 5% is right here. And then 10's over here. So all of these trades, those who've been trying to work with the spare call spread the last 8 months, every single one of them has been problematic. And then typically what people do in this with this type of trade for an adjustment is, let's say the market moves this way and then they get close to expiration, so they might have a couple days left, and let's say you're sort of in this zone, and so at that point you're just hoping the market retraces a little so you can end up over here and then boom, make your 10% on average. And then what happens is you'll end up in this area, but then once you're in a trending market, you're looking at ending up on this side and having just this tremendous loss. You can see down here it's just impossible to overcome. So what people are typically doing is when they get down to, let's say, a few days to go, then some of the traders will gamble and they'll just hold their breath and wait and see what happens. And then if it comes back this way, then they make the small amount here. But then as soon as they're wrong, boom, they just again lose an awful lot. Then you have another type of trader who, when they get down to this zone and there's not much time left, then they take this whole trade. So you have a short contract here and a long contract here. They take these two trades and then they roll them out farther in time. And so they might go out another, let's say 30 days, for example. Okay. But if you look at the design of this trade, notice that you only have about, in this case, less than 5% move in a month. And then when you look at this chart, so for example, let's just look at this chart maybe since the beginning of the year. And so we've gone up from 830 to 1050. So you're looking at 220 points divided by, again, we started at the 830 divided by 830. So that's a 26% move. Okay. And we're just completing we haven't completed 7 months yet, but almost. So if you divide by 7, it's about 4%. So we've been averaging in this trend about 4% every month. So if you come back over here and then you look at the 4%, it's really close to this line. So, because this is 5%, so the 4% is really, it's almost right at this point. So if you look at this, again, your general public that trade options, they consider this to be really high probability. But you can see when you're in a trending market, in this case the Russell, if it's averaging 4% a month, and then you look at the trade setup, 4% brings you right here. I think you can right away, I mean, on average, you can see that, especially if you don't have any other adjustment plan except for the probability, because a lot of people just try to go by that mathematical probability, and that's one thing we focus a lot in the course, is we talk about, although mathematically you have that probability, but look what's involved, look at the risk involved within that 80% or 85% probability. I mean, tremendous risk. So once you actually factor in the risk, and if you, for example, eliminate this part of the probability, see, most of this is just very risky. So if you keep this part of it, the safe part, the probability on these trades is only about 35 to 40%. Okay, and that's very important to understand, that with a credit spread and Condor, you're looking at somewhere between maybe 35 to 45%, what I call a realistic probability, the comfort zone, the safe zone. Okay, so those type of trades, again, very low probability once you consider the risk. At least half of the probability is in this zone, which is extremely risky and not safe to be in. So what I do is, when I look at probability on trades, I X this part out, because to me it doesn't make sense to include all that risk in my probability. So I like to look at more of a safe probability, what the probs are when I could be in a trade safely. So back to this concept, you can see in a trending market, then each month you're looking at ending up at that spot. So you can see with trying to guess when this market's going to reverse, okay? And a lot of people trade that way. They're counter trend traders. They see some technical and they think that the market's going to reverse, so they start to put on these bear call spreads. But then what if they're wrong month after month after month, which has been going on a lot lately. A lot of people have been trying to call the upside, and then they put on this type of trade. And then this is what happens. So typically, trending market, you're looking at ending up here every single month with this trade. Now, if you look at the risk profile, that's a tremendous loss. Right in here, you're like 50%. You can see this amount here oftentimes could be somewhere between 5 and 15%, depending on what deltas you use. But you can see on average, in a trending market, you're looking at somewhere in the middle here, just a tremendous loss. Like your investment on this trade could be around here, $9,000-10,000, and you're looking at averaging $5,000 loss per month. So even if you, again, roll this out, month after month with that adjustment process, and just putting the trade back on with the same amount of money, you could see that within 7 months, you could be down about $35,000. And then when you get one right, you're only looking at about $700, $800 profit. So that's what happens when you're a credit spread trader and the market starts to trend. Now the same thing goes with a Condor. So the Condor really, it just has the other side. Okay, so it looks kind of like that. And then the difference is it comes down a little bit here on this side too. So now you have the double-sided risk. And then your bar starts up a little bit higher since you're selling the credit on both sides. But the same thing could happen. So if you're in a trending market, again, on average, you're ending up in this location. So there's obviously ways to adjust. You can certainly try to sell more on this side and bring in more credit and lower that down and bring the side up. But typically when you apply your adjustments, you're lowering the bar, what I call it, lowering the bar over and over. And then at the end of the month, like I said, if you're lucky, you'll break even or not lose too much. But again, once you're in this trending market, then again, this very similar to the credit spread. It has the same type of problem. And then if you, again, do it over and over and over 7 months in a row, then you can just find yourself in a lot of problems. Okay, so one great solution to a trending market is a broken wing butterfly. Okay, the strategy has been around for a long time, but for some reason it's considered kind of obscure. I'm not really sure why, but I was drawn to this strategy nearly a decade ago, and we've really been perfecting it over the years. And it's just a very flexible strategy. There's so much you could do with it. There's so many variations, and it's the type of strategy that when your credit spread and your Condor wind down each month and they're just ready to lose so much money, the broken wing butterfly is actually in the opposite position and ready just to capitalize on that 5% move and make a lot. So let me just give you a basic sketch of it. Okay, so back over here, the way the broken wing butterfly looks, instead of having this area, you actually have an area that comes up over here, and then it goes down like this, okay? And then this part will usually start lower. So it's a different structure, but what happens is, as you're in a trending market, you can see the underlying moves about that 4 to 5% every month. With this type of trade, you end up where you have just a great chance at a very handsome return, where the credit spread and Condor trader could be losing up to 50% each month on average. Okay, but this one, like in this point, I mean, it could be the exact opposite. You could have a chance to make 50% on a month. It happens, not all the time, obviously, but you have that opportunity just by the trade setup. Okay, so there's, again, so many ways you can set these up, and they do have different characteristics. So we go through all of that in the course, but typically you're buying here, you're selling here, you're buying here, and then there's different ratios depending on the widths, the strikes you choose, and all of that, again, the widths and the strikes, all of that makes a difference on the trade, and so there's really an infinite way to set these up. But that's the general idea, and how this type of trade, again, broken wing butterfly, we call it like a BWB. But what's so great about it is, again, in a trending market, you just let the market come to you instead of trying to force a trade with a very poor structure and a lot of risk. Okay, so this trade setup has a lot less risk and has a much better profit potential. And the other nice thing about it is, again, you have limited risk on the left side. So if the market finally does decide to pull back, then the way that it's structured, like you see over here, then you really have your safety built in from the beginning of this trade for the downside protection. So it's nice. You have a lot of upside potential and a lot of built-in protection to the downside. So the last thing that I'll talk about, again, with our software, we actually build this strategy into it. So we have scanners for them. We have proprietary signals that help you know exactly when to enter, when to exit, what product to trade it on, things like that. So, since it is a very important part of our course, it's also become a very important part of our software. So we really help you find the best opportunities, and then also the software helps you know how to adjust them and everything. So thank you for watching that demonstration. Hope it gives you some ideas. If you're serious about learning all the nuances about option trading and advanced strategies, then please feel free to give us a call over at San Jose Options. And just go to our website, sjoptions.com, and we hope to hear from you soon.